right this time. Okay. So let's see. The beginning balance, different company, Water Source Company, and it included the $300,000 investment in Stewart stock. So the threshold here is 20%. So since they own 35%, they own more than 20%, they're going to have to use the equity method. Okay, that's the point that this thing was making. Okay. Now, that's going to be the beginning balance. So the first transaction is they purchased 2,000 shares at $13 per share of Jack Software common stock, and it's going to be a long-term available for sale security. You're going to spend cash to do it, and this will be to record purchase of the investment in stock. So if we took 2,000 shares times 13, we would have 26,000. Okay? Stop me if you think we're about to make a mistake. Okay? Now we received a cash dividend of 78 cents per share from that investment that we just bought. Okay? So 2,000 shares times 78 cents would be 15,060, 1,560. Let's double check. Let's see. Yep, 1,560. Okay, so if you got to use your calculator, it's fine. So that's going to be cash received and dividend revenue, right? So that's to record the dividend on the Jack, I think the Jack company, right? Received cash dividend. It doesn't need to be that specific. We just got a dividend, okay? Now this is where we had a sticking point, right? Received a cash dividend of 110,000 from Stewart Investment. Now remember, Stewart is, we have a 35% ownership interest in Stewart, so we cannot record it like a normal dividend. We have to record it using the equity method. Okay, we're going to show the cash coming in, but we're going to show a reduction to our investment in Stewart. Okay, it's a long-term investment in Stewart. Okay, so this is to record cash dividend under the equity method. Okay, so remember, this is the key point is the equity method comes into play when you own more than 20%, okay, but less than 51%. If you own 51%, then you're going to have to do a consolidation. That means that you're just putting two companies together. Okay, so let's see, 110,000. Check answer. Okay. By the way, this is a good problem to practice. Since you guys are here today, I'll give you a little hint. Right? Well, we put the video up and everybody gets the hint. But okay. Good problem to practice. Okay. Receive Stewart's annual report showing 120,000 of net income. So remember, we have a 35% ownership. So we take Stewart's net income, whatever it is, and we take a our percentage of that. We own 35%, so we're going to take 35% times the 120,000 that Stewart is showing as net income. Okay. And we're going to add that to our investment in Stewart. So long-term investment Stewart, 42,000. Okay. And this is to, what did we call it last time? Revenue from investments? 42,000. Sometimes the labels of the accounts differ. Let's see. Recorded revenue earned from investment in the equity method. Fantastic. Okay. Now, they throw this one in because they gave you Stewart's annual report. Now they're giving you Jack's annual report. But the thing is, Jack, we don't own 20% of Jack. We own less. So we don't have to do any kind of equity method journal entry. It's just going to be a no entry here. No entry required. Okay. Make sense? You sure?
Yeah.
Okay. Stewart stock fair value at year end was $232,000. Now this is a long-term hold to maturity investment. So when the market value of a long-term hold to maturity stock goes up and down, we don't have any kind of entry. Okay, it's just those available for sale and trading securities that we have to make those adjustments for. Okay. Now this is where it is. Jack's common stock fair value at year end was $14 per share. Remember, we bought Jack for $13, so it's up $1. Okay, so it's 2,000. There's going to be 2,000, right? Because we have 2,000 shares and it's gone up by $1. Okay, so those were going to be, and you might want to double check. Those were going to be long-term available for sale. So we have to make this fair value adjustment available for sale, right? And then we're going to have a unrealized holding gain for available for sale, right here. Okay. So with the available for sale securities, you have to make these fair value adjustments. Okay? And then we don't want to forget that we're going to have to combine that fair value adjustment with another number to get the balance on our balance sheet. Okay. So this is to adjust available for sale securities to market value. All right. Now we do our postings. So we have 1, 2, 3, 4, 5, 6, 7 entries to post. Stewart has a beginning balance of 300,000. That's the beginning. Okay. And then we work from there. Let's see. Okay, so long-term investments gets a debit of 26,000. And they didn't require a beginning balance. Okay. So this is the March 3rd entry. Let's see. That was this one. Dividend revenue gets $15.60 on March 15th. May 15th, right? Make sure you got the dates right. Okay. Let's see. Long-term investment, Stewart gets a debit of 110,000, a credit, I'm sorry, of 110,000 on December 15th. Okay. On December 31st, we're going to have a debit to long-term investment Stewart, 42, and a credit to revenue. Make sure my date is right. December 31st. You know, I might even move that other one down. Since it was kind of finicky about where we placed it, right? I might put this one down. Just based on that past experience. Even though it should be up there. I'll leave it like that. Okay. Okay, and we finally have that fair value adjustment and unrealized holding gain, 2,000. See, they don't have an account for the unrealized holding gain because it's just balance sheet accounts that they're showing. Okay. Then we got to take a balance. So let's go here and make balance. Call this balance. 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 And then we do the math. So you got what would that be? 190,000 plus 42. So that would be 232,000. Okay. 26,000. 42,000. 1560. And we almost made a mistake here, right? Because the one that we have to put in is that unrealized holding gain available for sale. That's, we got to put the title in here, right? That's the one account they don't give us the title to. Okay. And let's make sure 2,000, right? So the balance is 2,000. Okay, and we kind of eyeball it, make sure we're right. If you're not comfortable with your mental math, then you can go back and double check the ones that required you to add some stuff up. We'll see if my mental math is working. Okay, looks good. Give it a shot. Well done. Okay. So the difference is we don't, for these accounts we didn't need the beginning balances. Okay, it was just zero anyway.
But did you have to skip a line like that?
You know, I did. You could go back and try. You know, if you're gonna work this a few times, yeah, you shouldn't have to, but the program can get finicky about that. So you shouldn't have to skip a line. Let's see. So there are no current assets, right? All we have is the long-term investments, and we got a long-term investment in Stewart that has a balance of 232,000. And then we got the long-term investment available for sale. Remember now we have to combine the two, right? Because it's being presented at fair value. So the cost is 26,000 plus that adjustment of 2,000 would be 28,000. Okay, because we made this adjustment to bring it up to fair value. So we have 28,000. Okay, and then we have an unrealized holding gain on available for sale securities of $2,000, and that comes straight. These amounts come straight from those T accounts. It's just that these two need to be combined. Okay, this is the long-term investment at cost, and this is the fair value adjustment. So to present it at its fair market value, you have to combine its cost and the adjustment. That would give you the 28,000. Looks like we got it. We got it this time. Any questions?